time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
I sure am. So this question came in from Tyler, and he says essentially, if FVRR drops below $20 per share, is it worth taking a shot at? Question mark. In his question, he's kind of specifically, he says he's wondering if massive job cuts from tech companies, etc., could be a catalyst for the gig economy. So Fiverr International Limited, FVRR on the New York Stock Exchange, currently trading at a price of just or around $40 per share and has a market cap of about $1.53 billion. So the company operates an online marketplace worldwide, enabling sellers to sell their services and buyers to buy them. The company's platform includes approximately 550 categories in 9 verticals, including graphic and design, digital marketing, writing and translation, video and animation, music and audio, programming and technology, business, data, as well as lifestyle. And the company also offers freelancers software solutions for invoicing, organizing workflow, learning, and development offerings, and has a subscription-based content marketing platform. So some key points here is the stock did IPO in June of 2019 at a price of $21 per share. And it did have some pretty great early success in the COVID-fueled economy, but it is now down about 88% from its early 2021 highs, which you can see here on my chart. So the company just reported its Q3 2022 results on November 9th. Revenue was up 11% to $82.5 million. And this was driven by active buyers, which grew about 3% to 4.2 million. Spend per buyer grew about 12%. And Fiverr's take rate increased to about 30%, up from 28.4% for the same quarter last year. If we look at adjusted EBITDA, it was actually down about 10% to 6.6 million. And on a GAAP basis, the company is still losing money with a GAAP net loss per share of about 31 cents compared to a loss of about 39 cents for Q3 of 2021. And adjusted EPS, so the company does quote an adjusted figure as well, and they provided that they actually earned about 23 cents in adjusted earnings, which is up from about 21 cents in Q3 of 2021, which is last year. So Aaron did just do his recent segment on this essentially. So let's really take a look at why the earnings here are so different from the gap. So the only reason that Fiverr is posting adjusted profitability here is because of its large share-based compensation expense, as it is adding back approximately $17.6 million, or this would equate to about 47 cents per share in earnings, which generally we don't like to see, as this is holding the company back from GAAP profit. And this is essentially dilution. This is an actual cost that is being faced by the company. So I don't know if we can just completely ignore it. So moving on, the company did provide guidance as well. And looking forward, Fiverr anticipates fiscal year 2022 for revenue to be about 337 million at the midpoint, which would equate to about 13% growth year over year. As well, adjusted EBITDA is looking at about 22.5 million, which is actually a decline of about 2% year over year. And keep in mind, as you can see here on the page, we have seen the company now reduce its initial fiscal year 2022 revenue target by about 10% and its adjusted EBITDA guidance by about 25%. So, that's not something that we do like to see. The company does have a nice cash position on its balance sheet, but it still has a net debt position of just under 86.6 million. And on a forward enterprise value to adjusted EBITDA basis, the stock trades at about 72 times, which is not cheap. And even on a price to sales basis, we're looking at a multiple of about 4.6 times. And on a trailing basis, it trades at about 54 times adjusted earnings. That's all for a company which is growing revenue at about 13%, is not profitable on a GAAP basis due to share compensation, essentially. And it appears that growth is beginning to slow, as in the last 2 quarters, revenues were down sequentially, which is the first 2 quarters of declines experienced in the last 12 quarters. So to conclude here, the gig economy is an interesting space as it allows people to become the makers of their own destiny, which is why many millennials are gravitating to this type of freelance work, as it provides a bit of freedom and independence from an overbearing employer such as Ryan. Just kidding, Ryan. You're not overbearing. Just kidding. And as well, like looking at what Tyler was saying, an overall macroeconomic downturn and job cuts could help Fiverr find more supply of skilled workers for its gig economy platform. But what would happen to the demand side of the equation? Like, I would argue personally that demand for services would likely slow, potentially leading to lower revenue for Fiverr. So there might be, more freelancers on the platform, but, demand for their services might wane as well. So it might not actually benefit them as much as you think in a macroeconomic downturn. So I think at this point in time, we would stay on the sidelines given its pricey valuations, guidance which has been revised much lower, and what appears to be slowing growth. Even to answer your question, Tyler, if the stock was below $20, it would definitely be more appealing, as the stock, or at that point, the stock would be trading at about 36 times adjusted EBITDA and 27 times adjusted earnings. But again, even at those valuations, the low teen growth isn't that appealing. And I'm joking, Ryan.
Yeah.
You're not an overbearing.
Yeah, you're done. So no, no, I mean, I'd be a hard no for me. I mean, I get what's trying to be accomplished here and the reasoning behind, looking at this company, but even if the stock dropped to that range, you're talking about revenue growth of 12 to 13% and adjusted EBITDA growth, and this is adjusted earnings, not real earnings. Adjusted earnings was limited as well. If it had absolutely high growth, you might be able to sell somebody on it, 6 to 8 months ago. Now the market wants actual earnings and higher growth than that to be able to pay a multiple. So, I mean, unless something changes and growth upticks, I think the company's actually vulnerable.
Yeah, I would agree with that.
There's almost nothing that I see. So if you just in terms of reported earnings, they have nothing, or
it's a loss.
A loss.
Yeah,
it's a loss. Yeah, I mean, maybe at 10 or 12 times earnings, I'll look at it. That's a big
I mean, to me, it looks like right now it's
in this market
red
for 36
flags.
times earnings. There's much better companies out there in the tech space to buy.
And I'd also like to add too, it's headquartered in Tel Aviv, Israel. So I mean, generally we do see companies there kind of
actually trade at a discount. Yeah,
exactly.
A significant discount to others in the market, to be honest. And so again, another, not completely a red flag, but it's something that would actually give us a pause to say, well, this actually deserves a discounted model to some of the other tech names out there. We see that. I think that, we've used their services, to be honest. It's a good business, but there's many companies out there that you say use their services over the past 3-4 years, and they've been priced ridiculously in the market. This stock has been absolutely cratered, and to be honest, it probably deserves to get taken out and beaten a few more times, and can go lower.
Yeah.
Not that it's a bad company; it's just the valuation for us.
Exactly.
Yeah.